Buffett Way by Robert G. Hagstrom provides an in-depth look at the investment philosophy and strategies of Warren Buffett, one of the most successful investors in the world. Buffett, often referred to as the Oracle of Omaha, is known for his long-term approach to investing, his focus on value, and his ability to avoid market trends and emotional investing. Hagstrom explains the principles that have guided Buffett throughout his career and how they can be applied by individual investors. Here's a summary of the key themes and concepts from the book. 1. Value investing. At the core of Warren Buffett's strategy is value investing, a concept he learned from his mentor, Benjamin Graham. Value investing is about identifying undervalued companies, businesses whose stock prices are lower than their intrinsic value. Buffett looks for companies that have strong fundamentals, such as solid earnings, good management, and competitive advantages, but are being overlooked or undervalued by the market. Buffett's approach is patient and disciplined. He waits for the right opportunities to buy stocks when they are trading at a significant discount to their true value, and then holds them for the long term. He believes that in the short term, the market can be irrational, but in the long run, stock prices will reflect the underlying value of a business. 2. The importance of management. One of the key factors Buffett considers when evaluating a company is the quality of its management. He looks for leaders who are honest, capable, and have a clear vision for the future. Buffett believes that competent management teams are essential for long-term success, especially in navigating challenges and adapting to market changes. He values transparency and integrity in leadership, often favoring companies where management is aligned with shareholders' interests and demonstrates a deep understanding of the business. 3. The concept of economic moats. Another critical aspect of Buffett's investment philosophy is identifying companies with economic moats, sustainable competitive advantages that protect them from competitors. An economic moat can come from various factors, such as brand loyalty, unique products, high barriers to entry, or cost advantages. Buffett prefers companies that can maintain their competitive position over time, even in the face of market pressures. For example, companies like Coca-Cola and American Express have strong brands and customer loyalty that create a barrier to competition, giving them the ability to generate steady profits year after year. 4. Focus on long-term investments. Buffett is known for his long-term approach to investing, often holding stocks for decades. He believes that time is the best friend of a good investment. Instead of trying to time the market or make quick profits, Buffett focuses on buying high-quality businesses that will continue to grow and generate value over the long haul. This long-term perspective allows Buffett to avoid the pitfalls of short-term market volatility. He does not panic during downturns or sell off his holdings during temporary market corrections. Instead, he uses these times to buy more of his favorite companies at discounted prices. 5. Invest in what you understand. A central tenet of Buffett's philosophy is the importance of investing in businesses that you understand. He famously avoids investing in industries or companies that are too complex or outside of his expertise. Instead, Buffett focuses on companies with clear, simple business models that are easy to understand and evaluate. This focus on simplicity helps Buffett avoid speculative investments in new or unproven technologies. He believes that understanding how a company makes money and whether it has a durable competitive advantage is crucial for long-term success. 6. Margin of safety. Another key principle Buffett inherited from Benjamin Graham is the concept of the margin of safety. This means buying stocks at a price significantly below their intrinsic value to protect against unforeseen risks or market fluctuations. By ensuring a margin of safety, investors reduce the risk of loss, even if their valuation of the company turns out to be slightly wrong. Buffett is extremely cautious about overpaying for stocks, even for high-quality businesses. He waits patiently for the market to offer attractive buying opportunities and only purchases stocks when they meet his strict margin of safety criteria. 7. Patience and discipline. Buffett's investment approach requires a great deal of patience and discipline. He avoids the temptation to chase short-term trends, fads, or market hype. Instead, he sticks to his proven strategy of value investing, even when others are making decisions based on emotion or speculation. Buffett's disciplined approach extends to his decision-making process. He thoroughly analyzes companies before making any investments and is willing to wait for the right opportunity, even if it takes years. This patience has been a key factor in his long-term success. 8. Ignore market noise. Buffett famously advises investors to ignore the daily market noise, the short-term fluctuations, media speculation, and economic predictions that often drive emotional decision-making. Instead, he focuses on the fundamentals of the companies in his portfolio and trusts that the market will eventually recognize their value. Buffett's ability to remain calm during periods of market turbulence has allowed him to make smart investments when others are selling in panic. He often takes advantage of market downturns to buy stocks at discounted prices, confident that the market will recover in the long run. 9. The role of diversification. Buffett's view on diversification differs somewhat from the standard advice given to most investors. While diversification is commonly seen as a way to reduce risk, Buffett believes that it is only necessary when an investor does not fully understand the companies they are investing in. He argues that if you know a business well and are confident in its long-term prospects, it's better to focus on a few high-quality investments rather than spreading your money across many mediocre ones. Buffett's portfolio often consists of concentrated positions in a handful of companies that he thoroughly understands and believes in. 10. Learn from mistakes. While Buffett's track record is legendary, he has also made mistakes along the way. One of the lessons from the book is the importance of learning from those mistakes and using them as opportunities for growth. Buffett is candid about the errors he has made in his career and views them as valuable learning experiences. For example, Buffett has admitted to making poor investments in companies where he did not fully understand the business model or overestimated management's abilities. These experiences have reinforced his commitment to his core principles and made him a better investor. 11. Compounding and the power of reinvestment. Buffett has often referred to compounding as the most powerful force in investing. Reinvesting earnings allows wealth to grow exponentially over time. This is why Buffett advocates for long-term investments in companies that consistently generate profits, which can be reinvested to fuel further growth. By holding on to high-quality stocks and reinvesting their dividends or profits, Buffett has been able to maximize the power of compounding, allowing his wealth to grow substantially over time. Conclusion. The Warren Buffett Way provides valuable insights into the strategies and principles that have made Warren Buffett one of the greatest investors of all time. Robert Hagstrom breaks down Buffett's approach to investing in a way that is accessible and applicable to individual investors. Buffett's philosophy emphasizes patience, discipline, and a long-term focus. He believes in buying high-quality companies at reasonable prices, holding them for the long haul, and avoiding the temptation to chase short-term trends. By focusing on companies with strong fundamentals, good management, and sustainable competitive advantages, Buffett has built a remarkable track record of success. For investors looking to emulate Buffett's success, the key takeaway is to invest in businesses you understand, seek out value, and remain patient and disciplined in your approach.